Thanks. Afternoon, everyone. So I'll just start off by presenting our Shariah report from a market strategy perspective. And basically what we've done in this report, we have taken out all the companies that are non-Sharia. So the companies that we present in this report will be all Sharia compliant securities. So let me just give you an idea on how we see the market for second half of the year. So our view is that the market currently sentiment is very weak. We think that market is likely to still remain relatively weak in the third quarter, but we are hopeful to see a rebound in the market in the later part of the year. The reason why we think the market is likely to bottom in the third quarter is because if you look at sentiment in the market, we see that sentiment across retail, institutional investors are generally weak. At the same time, if you study the historical market downturns, you notice that in the past market downturns, 4 out of 6 of them actually bottom in the third quarter of the year. If you look at global financial crisis or even the Asian financial crisis. Now, in terms of catalysts that could potentially change the sentiment for the market, we suggest a few. We are seeing potentially the return of foreign workers in the second half of the year. We think that could potentially boost sentiment in the market. We are also expecting potentially higher tourist arrivals coming with the reopening of the borders. So we think that could boost the earnings prospect of some of the tourism stocks. Also, inflationary pressures could be subsiding, in the later part of this year. And there are some ESG issues in Malaysia that we think can be resolved perhaps in the fourth quarter. And this relates to forced labor issues. So in terms of strategy, we are advising investors to take shelter in some of the defensive sectors for now, stocks that offer higher dividend yields, and also some stocks that could benefit from the rate hike cycles, like the bank, and also potentially those that can benefit from return of foreign tourists. So in terms of Klci target, we currently have a end 2022 Klci target of 1506. And if you're talking about top 3 picks for Shariah, we have Bank Islam, Mr. DIY, and Telecom. Okay, so over this slide, I just want to, talk a little bit about an analysis on the bear market, because when we speak to investors today, they're quite bearish on the market. So we want to take a look at a bear case scenario. So what we did was we take a look at historical market downturns, 6 of them from 1996, and we actually apply, potential earnings risks during the past downturns into 2023 earnings forecast. So we take a look at COVID-19 and we take a look at global financial crisis. And during this period, we noticed that Klci earnings actually fell by about 9% and 7%. So if we apply that to 2023 earnings, the bear case for Klci, if we really go to the bear case like GFC or COVID, would be roughly about 1,200 or 1,213 or 1,245 points. So that would be the bear case. And I think if the market do go there, if it had not bottomed, then there's a very good opportunity to bargain hunt in the Klci. So I will talk a little bit about the 6 thematic we have for this report, as well as our top sector pick and so forth in the later slides. So just a very quick recap on first half performance. Klci actually fell by about 8% in the first half. We have several headwinds. We have the Omicron outbreak, and then we have the unexpected Russia-Ukraine war, and then we have the inflationary pressures from the high commodity price, and followed by minimum wage hike, and of course the rate hike by the US. So those have affected our market, and as a result, we saw the market declining by about 8% in the first half of the year. Now, if you look at the sectors that outperform in the first half, you'll find that they are the plantation, the finance, the REIT, and the construction. So in terms of what surprises in the first half of the year is basically the return of foreign investors. Foreign investors have been leaving our market, but we were positively surprised that they came back in the first half of this year. So if you look at the performance of Klci against the Hijrah index, you will notice that the Hijrah index has actually outperformed Klci in 7 out of the past 11 years. And if you look at the comparison between Klci and the Hijrah index, what you will notice is that the Klci index is heavily weighted on the banks, whereas the Hijrah Shariah index, you have the F&B, food beverage sectors, telco, utilities dominating the weightage of the Hijrah index. So if you want to see whether the Shariah index will outperform the Klci in a year where the bank underperformed, then the Hijrah Shariah index is likely to outperform Klci. Now, if you look at the first half of 2022, the Shariah indices have underperformed the conventional indices. This is because if you look at the sector performance, you see that the finance sector is one of the top performing sector for the first half of the year. So that explains the Shariah underperformance. Now, if you look at the performance of Klci against some of the global market, you'll notice that Klci have underperformed the other regional markets across the Indonesia, Thailand, Singapore in the first half of the year. And that is due mainly to, we think, some of the concern relating to policies as well as the rate hike. And also, Glove underperformed in the first half of the year. So that also partly explained the weaker performance. Now, if you look at performance of Klci stocks, you'll see that plantation and banks are stocks that outperform in the first half of the year. Now, as I mentioned earlier, one of the positive surprise is foreign investors turned net buyer in our market in the first half of 2022. And if you look at this chart, you see that foreign investors have been sellers in the last 4 years or since the G14. And this year they've been, big buyer, especially after the Russia-Ukraine war, because I think they see Malaysia as a potential inflation hedge market. Now, retail investors, on the other hand, their participation have dropped. I think the participation rate today is close to pre-COVID levels. And part of the reasons we suspect retail investors have seen lower participation is partly because of the higher stamp duty. And also, I think some of the rally in glove tax, they've ended. Foreign investors, they were a key buyer. I think one of the things we want to show is the flow of funds. So here you have 5 group of buyers. You have local entities, you have foreign, you have retail. And what you can notice is that the local entity funds have been net seller in the market since second half of 2020. And this is due to the fact that we have EPF withdrawal scheme. So some of the local funds would have to liquidate their position in the equity market. And that's why you see for the last 4 half, local institutional investors have been net sellers. And there was a big selling as well in the first half of 2022. Now, if you look at the retail investors, you will also notice that their net buying flows have also fallen. As I mentioned earlier, retail interests have declined. If you look at foreign investors, for the first time, we see, they are the biggest net buyer in the market in the first half of 2022. So this is a chart on the trading value of the market, and you can see that it's coming off. As I mentioned earlier, sentiment is quite weak in the market today. And our view is that market is going to bottom and probably we'll see a potential bottom sometime in third quarter. That's our prediction, and a rebound in the later part of this year. So in terms of what are the earnings risks, so why is people so bearish about the market? I think one of the concern is earnings risk. They're concerned that, commodity prices are coming down. We could see earnings downside for some of the commodity play. There are issues about labor shortages that could affect productivity of companies. And of course, you have inflationary pressures, and they're concerned that perhaps they cannot pass on this cost. On the policy front, you have policy uncertainty with regards to 5G. They are concerned that the telco will be charged with higher 5G costs, and that could lead to earnings downgrade as well. So we think in terms of catalyst-wise, if there are more clarity on some of these issues, then some of this sentiment on these stocks could potentially recover in the later part of this year. So going into the August results season, we are expecting potentially more earnings disappointment. So this is our analysis of the historical market downturns, and it basically shows you, the duration of the market downturns and what are the sectors that could outperform once the market recovers. So typically, the cyclical sectors will recover when the market has bottomed and start recovery. So those would be your light of tech, construction, property. Those would be the cyclical sectors that tend to recover faster once market has bottomed. So in terms of what could catalyze the market, what will be the key events that we're looking for in the second half of the year? We are looking at policy clarity with regards to foreign workers, 5G wholesale costs, as well as some of the concerns relating to construction projects and so forth. I think if those can be clarified, it will be positive for the market. We will be also looking for trends on tourist arrivals in Malaysia. If we see a strong recovery, I think that could also catalyze the market going into later part of this year. Now, in terms of the other potential catalysts, we see potential return of local insti funds to invest in the local market, given that there are no more EPF withdrawal schemes. So the EPF will see higher contribution coming into EPF, and that could potentially be invested in the equity market as well. Okay, so we did a survey on retail investors sometime in June, and what the survey shows is that a majority of the retail investors that responded to our survey indicate that they are bearish on the market. So 47% expect market to post a negative return. Now, if you ask them what are their biggest concern about the market, they will say first is the economy, and they're also concerned about what they are seeing in terms of sharp decline in stock markets around the world. And the other factor they are concerned about is the rising rates. However, they will be keen to come back to invest in the stock market if they do see that the stock market may have bottomed, or the economy is not as bad as they think, and there are more political stability. So those would be the catalysts that the retail investors will be looking for. Okay, we also did further studies on ESG rating from FTSE for Good Bursa Malaysia Index, and we noticed that more and more companies in Malaysia are entering the FTSE for Good Index. Also interesting to note is that Malaysia's weightage in the FTSE for Good for emerging market is higher than their weightage in the FTSE Emerging Market Index. So that suggests that we have seen improvement in ESG practices in Malaysia. So this is a positive for the market. Now, I'll just now discuss the trading teams. So the first trading teams we are suggesting to our clients is relating to a beneficiary of OPR rate hike. So these are mostly the banks. And in Malaysia, the Islamic banks that we like will be Bank Islam. So this is one of our top pick for second half of the year. The other trading teams is stocks that could potentially benefit from a weaker ringgit. environment. So we've seen ringgit weakening in the first half of the year. So if you're looking for potential stocks that could benefit from this trend, it'll be your exporters, companies that have a lot of foreign subsidiaries. So these are the screening of the stocks that we think will benefit from a weaker ringgit trend. The other theme is high dividend yielders. These are stocks that will give you dividend yield of 4% and above. We have screened them to only cover the stocks that our analysts like, so they have an ad rating. At the same time, they have high dividend yields. So the lists are in the table. Then we have a team called Potential GE 15 Beneficiaries. These are stocks that we think could potentially benefit pre or after election. For us, one of the stocks that we think could benefit are all the regulated asset stocks like Tenaga, telcos, due to better policy clarity. So you will also notice that stocks generally tends to perform better post-GE than pre-GE on average historically. Okay, and these are the stocks that we have screened that we think could benefit from post-GE. Okay, the next theme is on value play, and these are stocks that we like, and they're trading at price to book value of 0.5 times and below. And most of them you'll find are in the sectors like property and media. So these sectors have seen a big decline in their share price. They're trading at 0.2, 0.3 times price to book value. The problem with these stocks is they don't have a catalyst, but to some extent, downside is protected because they're trading at very low price to book value. So we have ESG picks, and these are stocks that rank highly with all the third-party ESG assessors. So we have ranked all of the stocks under our coverage that we have ad calls, and we look at their ranking in terms of ESG from all these four assessors. So those stocks that actually rank very high with all the ESG third-party assessors will be selected. So our pick here will be MIC, Dialog, Maxis, Sunrise, and FNN Holdings. So this is our screening, and these are the rating by how you read the rating for all the ESG assessors. Okay, so in terms of risk, I would say that perhaps risks that investors have not priced into the market today would be, for example, if there's an emergence of very deadly COVID-19 variants and we have to go back into some form of lockdown, I think that will be a negative surprise for the market. Corporate earnings, we think that upcoming result seasons, you will see potential earnings disappointment. And these are the historical earnings revision ratios. So you can see that they've done very well during the COVID period, but we think that it has peaked, and going forward, we could see more earnings disappointment. Now, in terms of foreign funds, we have heard concern from investors saying that, with a high foreign funds inflow, would they potentially flow out if US dollar strength continue? So these are our analysis on the sensitivity of, foreign shareholding level in Malaysia against fund outflow. Now, one of the ways to see in the event, should foreign funds decide to exit the market, what are the potential stocks that are vulnerable to foreign funds selling? So what we did was we take a look at the top stocks that foreign funds bought into in the first half of the year. And you can see from the table here, there are names like Petronas Chemical, Press Metal, Simeplan. Those are the names that foreign funds have been buying in our market in the first half of the year. So this could be stocks that are vulnerable for selling in the event funds decided to exit the market. Okay, and this actually shows you the stocks with high foreign shareholding that could be potentially vulnerable as well, if you're concerned about outflows. So if you look at the market, and if you study the PE band of the market, you will notice that historically, market tends to bottom at 3 standard deviation below their historical mean PE. So we are close to that. We are about 2 standard deviation. We are trending about 2 standard deviation below the historical mean. So to some extent, we think that market has priced in the negativity that we are hearing in the market. So this actually shows you the sensitivity of our target KLCI based on different valuation. At minus 2.5 standard deviation below the mean, we have 1506. But if you really want to price the market at minus 3, then the targets will have gone down to about 1433. Yeah, so I think we are close to the bottom of the market. Okay, this is our forecast by our economist. He's expecting GDP growth of about 6.2% for 2022. He expects further fiscal consolidation going into 2023. And we are projecting another rate hike, 25 basis points for the rest of this year, and another 50 basis point rate hike in 2023. So this is the macro forecast. Technical analysis for both KLCI and Hijra at this moment looks quite bearish. This is our peak for the big cap as well as the mid cap and small cap, and they have all been screened for Shariah compliance. And this is the sectors that we have overweight as well as neutral calls on. And within each sectors, we have also put out our analyst top pick for that particular sectors. For example, banks, the top pick would be Bank Islam. And if you look at healthcare, our top pick there would be IHH Healthcare for that particular sector. Okay, so I will conclude with the top 3 picks that we have for the market for second half of the year. This will be our top 3 Shariah pick. So one of the pick will be a beneficiary of rate hike, and Bank Islam we think will benefit from that. We are projecting, higher loan growth compared to other banks. We're also expecting valuations to be attractive at this level, and there could be potential earnings upside if we see more rate hike going into next year. So Bank Islam will be one of our topic. Second topic is Mr. DIY, and we think this stock could be a beneficiary of down trading. If people were to down trade because consumer sentiment is weak, you could see potentially the middle income down trading and buying from Mr. DIY or even a high income, and at the same time they will still have the spending from the low income group. So that is a stock that we like on the consumer sector. And the third pick is Telecom. The concern for the telco is relating to the 5G wholesale cost. Our analysts think that this will be clarified in the next few months, and once that clarification come through, we suspect the telco could re-rate. And if you look at the telco sectors, when one of the 3 worst performing sector, top 3 worst performing sector this year because of the 5G concern, and we expect them to re-rate as we go into later part of this year. So telco will be one of the overweight sector that we have for second half of the year. So with that, I would like to end my presentation and thank everyone for their attention. Yeah, thanks.